Ladies and gentlemen, good day and welcome to Q3 FY22 earnings conference call of AMI Organics hosted by Axis Capital Limited. As a reminder, all participants' line will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand over the call to Mr. Mehul Sheth. Thank you, and over to you, sir.
Yes, thanks, moderator, and good afternoon, everyone. On behalf of Axis Capital, I welcome you all for the AMI Organics Q3 and 9 months FY22 earnings call. Today from management team, we have Naresh Patel, MD, and Abhishek Patel, CFO of AMI Organics. Now I hand over call to Abhishek for his opening remark. Thank you, sir.
Thank you, Mehul. Good afternoon, everyone. We are pleased to welcome you all to our earnings call for quarter Q3 FY22. Please note that copy of disclosure is available on the investor section of our website as well as the stock exchanges. Please do note that anything said on this call which reflects our outlook towards the future or which could be construed as forward-looking statement must be reviewed in conjunction with the risks that company face. With that, I would like to hand over the floor to our Chairman and Managing Director, Mr. Naresh Patel, for his opening statement.
Thank you, Abhishek. Good afternoon, everyone. I am Naresh Patel, Chairman and Managing Director of AMI Organics. Heartily welcome you to our Q3 FY22 earnings conference call. I hope you and your family are safe and sound as COVID continues to cast a shadow on day-to-day lives. We continue to maintain the highest level of safety measures at our plants and offices to keep our most important stakeholder, employees, safe. Coming to the results update, our business grew by strong 52% on year-on-year basis in 9 months to rupees 3,776 million. The growth was driven continued robust growth in core pharma intermediates business as well as strong growth in specialty chemicals business. I will let Abhishek discuss financially in the detail. On the business side, our core business continues to grow on sequential basis with a robust growth in year-on-year basis. Coming specialty chemical business, our process improvement and cost optimization exercise is running in full swing, and we have already started in the results of the same. Our EBITDA for facilities acquired by Gujarat Organics has improved sharply, but it has not yet achieved its full potential. One of the strategies to improve the efficiency was to transfer the production of chemicals business at one site rather than having the same product at both the sites. In line with the strategies, we have transferred the chemicals manufacturing at Ankleshwar site to Jagadia site, and now all the specialty chemicals production will be happen at Jagadia site. This strategy will help us improve the utilization level and in turn improve our operating leverage, which will lead to margin expansion in coming quarters for this facility. We have already shifted productions from Ankleshwar facility to Jagadia facility during the quarter, and I do not expect any revenue loss for the year. We plan to build brand new state-of-art facility at Ankleshwar site for expansion of our core business of pharma intermediates. We are working out detailed engineering and designing for the same, and we will discuss the capex plan in details once it is ready. On the product side, our 2 new import substitute products launched recently are seeing good traction in the market with very encouraging response from the customers. We believe these products will contribute considerably to our top lines from coming year. We have more import substitute products in the pipeline, and we will keep you updated on the same as we make new progress. They are all in a pilot stage currently. Overall, I remain optimistic for the coming quarters on the back of continued strong demand of our products, rationalizations in the input prices, successful integrations and cost optimization in GOL business, and new product launches. Now I request our CFO, Mr. Abhishek Patel, to discuss the financials. Over to you, Abhishek. Thank you.
Thank you, Naresh bhai. Good afternoon, everyone. I would like to briefly touch upon the key performance highlights with the quarter and 9 months ended December 2021, and then we will open the floor for the question and answers. I will start with the quarterly update. Revenue for the quarter was at rupees 142.1 crore, up 53.5% as compared to 92 crore in Q3 FY21. The gross margin for the quarter were at 49.4%. For most part of the quarter, input price remained elevated, but our prudent cost measures and ability to swiftly pass on incremental input costs to the clients help us not only maintain our margin but improve our gross margin in our core business. Overall, at consolidated level, due to lower margins in Gujarat Organics business, our gross margin looks flattish YOY basis. EBITDA for the quarter was 29.9 crore, up 37.9% as compared to 21.7 crore in Q3 FY21. EBITDA margin was 21.2%. PAT for the quarter was 19.5 crore, up 34.7% as compared to 14.5 crore in Q3 FY21. PAT margin was at 13.8%. Last quarter, I had mentioned that traditionally we have been growing sequentially, with Q1 always the lower performing quarter and Q4 being the best. This trend pretty much visible in our performance for the current year, with Q3 being better than Q2 and Q2 being better than Q1. We believe this trend will continue in Q4 also, and Q4 will be bigger than Q3. This will lead to H2 contributing more to the top line than H1. Now coming to the 9-month figure, our revenue grew by impressive 52% to rupees 376.6 crore as compared to 247.7 crore in 9 months FY21. Our gross margin for the 9 months expanded by 290 basis points to 48.8%. EBITDA for the 9 months was at 79.4 crore, a growth of 39.5% compared to the same period last year. Even with the impressive EBITDA growth in EBITDA, our EBITDA margin remains suppressed at 21.1%. EBITDA for the core business continued to be robust, but the EBITDA for newly acquired facility also improving quarter by quarter and surpassed 2-digit mark, but the overall EBITDA gets dragged post effect of integration. On the positive side, our business improvement and cost optimization exercise has already shown results, with EBITDA for GOL facilities trending towards double digits from single digit mark in last year. We believe this will further improve in coming quarters as well. Now PAT for the 9-month FY22 was at 50.7 crore, up 31.3% as compared to the same period last year. PAT margin for the 9 months came at 13.5%. EPS has also increased from 12.25 to 16.8 per share. Coming to the balance sheet item, we have brought down our debt from 136.6 crore as on 31st March 2021 to only 73 lakhs as of 31st December 2021. Cash and cash equivalents at the end of the December 2021 were at staggering 116.2 crore. I would like to note that input cost has started rationalizing from December, and we believe that this will further boost our margins in future. Before I conclude my remarks, I would also like to highlight that FY21 number does not include revenue from the 2 newly acquired facilities. It was because it was a slump sale asset transfer case. I will now conclude my remarks and request the moderator to open the floor for the question and answer session. Thank you.
Thank you. We will now begin the question and answer session. Participants present on the audio bridge who wish to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from Amar Maurya with Alpha Accurate Advisors. Please go ahead.
Yeah. So thanks a lot for the opportunity. Couple of questions. Sir, firstly, if you can give us the breakup between the pharma intermediate and the specialty intermediate for third quarter, second quarter, and first quarter for the revenue and EBITDA. Hello?
Yeah, wait a moment. Yeah.
So for 9, you want quarter by quarter or you want?
Yeah, quarter by quarter would be great, sir. Then we can understand that, how the margin has improved for the specialty chemical business.
See, on the revenue side, quarter 1 for pharma business was 94.13 crore, quarter 2 was 102.14 crore, and quarter 3 was 118.53 crore. 118.53 crore.
Okay.
On the EBITDA side, quarter 1 was quarter 1 unit 2 and 3 in specialty business was 19 crore, then it increased to 20.17 crore, and then it increased to 22.62 crore in Q3 FY22. The margin side, the EBITDA margin for Q1 was around 5.5%, which increased to 13%, and then further increased to 14.1% in Q3 FY22.
Okay. So basically, specialty chemical margin increased from single digit to double digit in third quarter. And what would be the peak margin, sir, we can do in the specialty chemical business?
Margin-wise, as we discussed earlier also, the margin for the specialty business may remain around 3 to 4% lower than the intermediate business. So that is what we are expecting in future at the peak level.
Basically, let's say if I see your standalone margin of your pharma business in 21 used to be 23.5%, and this was the 23%. So basically, when you say 3-4% lower, so you are saying 19% kind of a margin on specialty chemical business would be possible?
Yes, that we can expect at a peak level.
Okay. And secondly, sir, as you indicated that now the shifting of specialty chemical business completely is done to Jagadia. So, and because of that, the utilization suffered this quarter. So, once now the shifting is done, I mean, how we can see the improvement in the run rate of the specialty chemical business in fourth quarter, and going forward, what kind of utilization we can expect from the specialty chemical business?
First of all, let me correct. There is no utilization suffer. It is continuously. It's a successful transformation without any interruption in the production of the specialty chemical. So it's done very properly in such a way that phase-wise we have transferred the product to the Jagadia side so that our orders and our production will not be impacted on that. So this is and that is also one of the reasons that the revenue and Jagadia means unit 2 and unit 3 because of that only. So and that will be going to be both the sites cumulatively utilized 40%. Then 40% will be remaining utilizations at Jagadia. So and we have a further possibility of increasing the utilization up to 85 to 90%. So it's still very huge volume available to make more growth into utilization.
Okay. So that was my question, sir. Basically, what I'm trying to understand, like, as when we acquired the plant, it was only still 35% utilization of the specialty chemical business. Now, going forward in FY23, what are the levers for you to improve your utilization level? Do we have some larger contracts or some new client win which will help us to improve the utilization of specialty chemical business?
We are expecting to go up to 85% in next 2 financial years.
Okay. So basically, by FY24, you are expecting to 85% utilization level, correct? Hello?
Yes, sir. Yes, sir.
Okay. Perfect, sir. I'll come back in queue.
Thank you. The next question comes from Hardik Shah with Taurus Mutual Fund. Please go ahead.
Hi, sir, and thank you for taking my question. So my question is a small follow-up on the previous discussion. So now that, sir, the operations are consolidated at Jagadia, what is the current revenue potential of that site now, sir?
Current potential in this year, as we had already announced, that we will be maintaining the same revenue as the Gujarat Organics last year revenue. The reason is that we already lost 2 months in the takeover process. So the same revenue in this financial we are expecting from Unit 2 and Unit 3.
Sir, my question is peak revenue potential. So what is the maximum we can reach in Jagadia now, sir?
Okay, I think you wanted to understand the potential revenue post this shift, right?
Correct.
So, correct. You notice that we have transferred most of those equipments from Ankleshwar side to the Jagadia side.
Correct.
So that capacity of those 2 units which were separate at 2 locations, now it consolidated 1 location. So overall capacity remains intact as of date also.
So, sir, is it slightly more than 200 crore? Is that number right?
Around 200.
You can assume like that.
Yes.
Understood. And sir, in terms of land bank, sir, at Jagadia, sir, in terms of number of acres, sir, how much room is there for further expansion, sir?
We have 16,900 square meter is still available for further expansion.
Perfect, sir. Perfect. Sir, so right now, at the entire Ankleshwar unit, bearing a few equipments, is left for the core AMI business growth, right, sir?
No.
I'm just making that sure.
No. Entire Ankleshwar unit, we have completely demolished it and then refurbished and rebuilt it as advanced facility as required for pharma intermediates, and that will be good for us for revenue FY24 and 25.
Correct. So right now there is 0 revenue from that unit, or next to 0 revenue.
This quarter, yes.
Perfect. Got it, sir. Sir, can you please share your export revenue and export EBITDA margins for the current and last 4 quarters, sir? Hello?
Yeah. He's taking the. Yeah.
So export has been 212 crore for this 9-month FY22.
Mm-hmm. So can you give the quarter-wise breakup if possible, please, sir?
So this quarter it was 89.43 crore.
Okay. And sir, for the previous Q1 and Q2, sir?
It was 64.48 crore.
Okay.
And for first quarter it was 68.83 crore.
Perfect, sir. And sir, roughly, sir, can you give the average ballpark margin number, EBITDA margin number, sir?
The average EBITDA, as we speak, we generally, it has been trend that our export and domestic business has not much of the gap between margin. It's always specific to product and product basis. It's not like that some of the products which are going into exports is going at a very lower rate in domestic market. Even in some of the regular export customers are buying even lower rate than the domestic customers whom we are selling it to. So generally, margins are not geography specific or export or domestic specific. They are more of the product specific which drives the business.
Got it, sir. Got it. So if possible, sir, can you share where the margins are higher, sir, export or domestic, or is it almost the same, sir?
No, it depends on the product mix. Some let me give you an example. In 2020, we had one of the domestic product where we had a cost improvement, and that was going into domestic market. So in that year, the domestic margins were higher in terms of total value as well as the percentage term in FY20. But in FY21, it was export who drove the margin because of one of the export product got the higher amount of revenue in 2021. So it's always a product specific rather than the market specific.
Perfect, sir. Perfect. Got it, sir. And sir, sir, I'm not asking you for the capex number or something, but sir, on the broader level, sir, on the strategy front, sir, initially now the first capex will happen at Ankleshwar for the core AMI business. Is that right? And post that, if at all, we do a capex on Jagadia. But first we will focus on the core pharma intermediate business at Ankleshwar. Is that correct, sir?
Yeah, because the specialty business has already enough capacity for FY23-24.
Correct.
So why we first focus on core business expansion, and then we will focus on Jagadia.
Correct, sir. Thank you so much, sir. That is all from my side.
Thank you. The next question comes from Anubhav Sahu with MC Research. Please go ahead.
Hello. Hi. Thanks for the opportunity. Couple of questions. One is, I understand for Ankleshwar side, you want to repurpose it for pharma intermediates. So, as of now, do you have any further details on that? What kind of capex you are looking at? And would you require fresh EC for this site for the new set of products?
Yeah, thank you very much for this question. It's a very important. We have already initiated AC-related activity, and we already received the environment clearance in 2 months back only for Ankleshwar site.
Okay. And post the shift of specialty to Jagadia, so what is now the the net capacity for Jagadia plant?
See, the capacity point of view, because all the infrastructure related to equipment is also transport to Jagadia. So the capacity will remain the same in that sense. So the utilizations for both the facilities already at one single location. So now there is instead of 2,400 metric ton in Jagadia, it will be converted to 3,600 metric ton.
Okay. And one last question is on your molecule and markets. If I remember right, 40% of our sales come from the intermediates for two molecules called Trazodone and Dolutegravir. Are we getting the similar set of sales from these two molecules, or it has changed since the time of IPO?
See, since IPO also, we always said our USP is we are not dependent on any product and we are not dependent on any customer. And this is a classical example is proving that though in the last financial year, Dolutegravir was one of the largest product, second largest product, this year it is not performing even in a top 8, top 9. So even though our growth is maintaining, so and that proves that we are not dependent on any single product or any single customers.
Okay, got it. So, do we understand that the antiretroviral market has been soft for last few quarters? How do you foresee the demand come in the coming quarters? I mean, is it picking up, or how do you see the order book on this thing?
Yeah, this quarter 4 we got it started picking up for Dolutegravir.
Okay, and this is the as for the antiretroviral, this is the only molecule we have. I mean, this is the only molecule we are catering to.
In antiretroviral, we have 3 molecules, but 2 are still under very early stage of development, and it is yet under patent. Whereas Dolutegravir is already commercialized, so that is only one which is right now is under commercial at a higher level of contribution.
Got it. And I suppose mostly for the domestic market, right? As far as this segment is concerned.
Dolutegravir is for domestic as well as export all, but exports are still, because it's still under patent, so the generic player is yet not started manufacturing. So they are qualified AMI Organics, but they are waiting for the expiry.
Okay, got it. It's quite helpful. Thank you. Thank you.
Thank you. The next question comes from Padma Raju Mathi with SBI Life Insurance. Please go ahead.
Yeah, thank you for taking my question. So my question is more related to this two new import substitute products that you have commercialized. So just wanted to check, is this on the spec chem side or the pharma side?
Both are in pharma side.
Okay, both are on the pharma side. So sir, can you throw more color on that front? Like what is the kind of...
And one is for the anti-diabetic disease.
Okay, and the kind of opportunity size that you see in these products?
Both the product has a sizable volume in terms of production as well as the value point of view. It is a multi-crore product. So it will be going FY23. It will be contributing sizable amount of revenue in our total projections.
Okay. And my next question is related to your spec chem side. Like, just wanted to check, regarding what are the facilities that we acquired from GOL. I know that we have operated at lower utilization levels in the past, but how do we plan to scale this business up? I mean, do we need to do anything on the product pipeline side, or in terms of acquiring customers? So if you can help me on that front, it will be great.
Thanks. This is a very good question, I can say. In Gujarat, business is very, very good, and we are not working only on a one sector, but we are working on cumulatively all the possible way increasing the business of Gujarat. Not only in increasing the capacity of the product, we also improving in the process improvement so that we can improve the CROCS of the product, as well as because as per FNS report, the contribution, the potential of the Gujarat Organics business is much higher than what they are doing right now. They are doing only 3 to 10% kind of total contribution in the world market. So it's a huge potential is available for all of the products. So we started working on that. We started reviving the customers. We started improvement in terms of quality, operation point of view, packaging, and also marketing. And that also shows the result that so many new customers already added in the basket. Upcoming years, it will be giving us the fruit on that because qualification process is going on.
And how does this contract generally work? I mean, is it like we do have some sort of an order visibility, or it will be more like an catalog sort of a product?
See, in the core business, we have a long-term contracts in exports, and that long contracts between 2 years to 6 years kind of contracts with visibility of minimum 1.5 year of all the requirement, and that is backed up with the raw material escalations and monitoring escalations kind of things. And so this is how we have a visibility of our contracts.
No, sir, I'm asking more on the spec chem side.
GOL, there are not that much big contracts we have, but in future we will start that as well. Because it's a just acquired facility, right? So some contracts which is already with GOL is void off, so that we have to renegotiate and we have to make in our system.
Okay. And last question, this quarter, I believe our tax rate was higher because of a deferred tax rate. But what will be the normalized tax rate that we can work going ahead?
The normal tax rate, since we have opted for new regime, it will be 25% only. But in this quarter, let me bring to your notice that in this quarter we had a restatement of our liability, gratuity liability for our acquired business, and because of that there were restatement of deferred tax asset as well in this year, for which we had availed some of the tax benefit in last quarter. So because of this adjustment of liability, we had a higher tax rate in Q3 FY21 as compared to Q3 FY22 as compared to Q2 FY22. But the normal rate, if you see on the 9-month basis, it is around 26% only.
Okay, sir. That's it. Thanks.
Thank you. The next question comes from Hemant Tyagi with Varanium Cap. Please go ahead.
Yeah. Thank you for the opportunity, sir. So this was on the R&D spend that we are planning to do for FY23 and 24, which has roughly been in the ballpark number of 1.5 to 2% of our revenue. So would you like to give some number on the R&D spend for FY23 and 24 if possible? And that was the first question. The second was on the new product pipeline that we are planning for FY23. Would it be right to assume that we will be launching around 4 to 5 products, new products in FY23? And probably it will be in what therapy, chronic or acute and things like that. If you could give some, throw some light over there. These are the two questions.
Thank you. Normally, R&D expenditures will be, as you rightly says, that in the range of 1.5 to 2.5 between that of our total revenue, and that will be remain in that segment. But recently, we have done a lot of technology and improvement in our installation and working on flow chemistries as well as fixed bed chemistries kind of things, as well as some other cryogenic kind of things, which is we have already started, and we successfully implemented flow chemistry for 2 molecules. So that is incremental investment in R&D, which is next couple of years. It will, so maybe our R&D expenditure may increase from 2% to 3% kind of things, or 3.5%, but that is all depends on how fast we are working on that. And in terms of new molecules, or annually, as we say that annually we develop 20-25 molecules every year, and that is in our core segments only. We don't work like acute or chronic kind of things, but we're working on a therapeutical kind of things where we have 50 therapeutic area in pharma, where we are mostly focusing on in that area. Whatever the new molecules are coming, that we try to develop intermediate for that. So it will be continuously focusing on that. In terms of apart from these core pharma, but as now we also want to grow our specialty chemical segment as well. So there are a few molecules are working in specialty as well, and which is in specialty only we are bringing these flow chemistry kind of things which is successfully commercialized, and now we are operating at annual monthly 20-25 metric tons kind of capacity of this kind, and that is continuously invested in that. And our target to introduce 4-5 molecules in specialty chemical, specialty segments as well annually.
Okay. If I can squeeze one more question. So on the specialty side, we said that the margins, we expect them to move from 14 to 19 over a period of next 2 years. That would be basically because of the backward integration, or we are getting into products that have got higher margins on the specialty front?
See, currently whatever we are saying is for the product pipeline of Gujarat Organics, where we are not introducing new molecule to increase our. We are increasing our margin with the better efficiency, operational improvements, process improvements, and apart from that, all other process control, and these are all things which is on backward integration. These are all things which is cumulatively planned for 1 year, and that is also showing that improvement in quarter to quarter, every quarter improvement in the margins of Gujarat Organics.
Okay. So these all are internal factors that make us confident that we will achieve, and we are not dependent on the markets or new products or margin improvement.
You are right.
That answers. Yeah. That answers my question. Thank you.
Thank you.
Thank you. The next question comes from Prashant Nair with Ambit Capital. Please go ahead.
Hi, good evening. Just a couple of questions from my side. The first one is a clarification. You mentioned a utilization number for your Jagadia plant earlier. I missed that. Can you just, give me that number again? What is the current utilization at Jagadia?
The 40% utilization at Jagadia plant.
All right. Thank you. The next question is, more of a, just to get a general sense from you without naming any specific products. So when we look at your top 5 or top 10 products list now by revenue, do you think you could see some products coming into the top 5 or top 10 over the next 2 to 3 years? Or rather, if you could, how many new products do you see coming into that list? That will give us some sense of, the possible growth trajectory.
Some of the products like Nintedanib, Apixaban, Rivaroxaban, and Darolutamide, those are the products which are contributing, started giving us a good contribution in the revenue, totaling to more than 10% of the total revenue. And those products are definitely a good candidate to be in the top 5 products or top 3 products kind of trajectory for us in future. Apart from that, methyl parabin is one of the products, and
para-anisilic acid.
Those are the 2 products from Gujarat Organic site, which has the capacity to be one of the top 5 products in total revenue pie of the AMI Organics revenue.
So sorry, I did not get the second product from GOL side, methyl parabin and
para-anisilic acid.
Okay, all right, got it. Thanks a lot.
Thank you. The next question comes from Amar Maurya with Alpha Accurate Advisors. Please go ahead.
Yeah, sir, thanks a lot for the opportunity again. Sir, just wanted to understand, in last quarter, we were expecting that, the pharma margin can improve from quarter to quarter. So, if I see sequentially, pharma intermediate margin has slightly shrunk. Is it more to do with the supply chain issue which other pharma companies are facing, or these are the kind of margin which are going to be kind of a peak margin for pharma?
See, let me update you that our business is a multi-product kind of business, and the product every quarter depends on the customer's preference for delivery and customer's plan for that annual requirement. So sometimes quarter by quarter, because of change in product basket, revenue, and the EBITDA margin shifts ups and downs. But if you see in totality for 9 months, for 9 months of performance, you will realize that we have still been able to maintain margin of more than 23%, which we had last year also. So despite of all this turmoil which we heard in the market, you can appreciate that we still have maintained our margin. One of the area which is not been planned earlier is the freight cost, which has increased by almost 1.3% as compared to the previous financial year. So if that not has been there, we would have even expanded. We would have expanded our margin for pharma business also, which is right now intact.
Okay. So basically, there is a scope once this elevated cost of freight and other things cools off, we can see some improvement in the margin in the pharma business as well.
Definitely, sir. Even you can see that margins are improving if you see on a 9-month basis as compared to the previous year.
Correct. That is true, sir. That is the reason I asked you. Thank you. Thank you, sir.
Thank you. The next question comes from Praneeth Agarwal, an individual investor. Please go ahead.
Hello. Hello. Am I audible?
Yes, sir.
Yeah. So my question was regarding the integration of GOL facilities. So we assume we are on track with the integration of shifting of infrastructure. So could you give us a timeline when we'll achieve the complete integration?
Infrastructure is already transferred and it is installed there. And it is continuously production without hampering any production. We have done that successfully. Now we are trying to improve in the where we are now trying to integrate all the operations in a such a way that the optimizations of each product will get in this quarter.
Yeah. So in the beginning of the call, you mentioned that we are improving the margins from the GL facilities. So could you give a timeline on the timeline when we'll achieve the peak margin utilization from GL facilities?
The margin improvement is a continuous process. Not even if we talk about the revenue peak margin, that can also be shifted beyond the 90-20% trajectory. But if you see, we have improved our margin from 5% trajectory to the 13-14% level in 3-quarter time after acquisition on the last day of financial year FY21. So we have been even working ahead of what we have planned to achieve in this FY22 things, and going forward in next 2 years, we will definitely be able to reach at the peak margin what we said during the call earlier.
Okay. And any other plans to improve the margins like debottlenecking?
See, we are working on a multi-task in that: improvement in the operation, improvement in process, improvement in the backward integration, improvement in the technology of process as well, in putting removing the conventional process with very updated process kind of things, technology kind of things. This is how we are multi-level. We are working on that, and that is the reason why it was targeted a longer time to reach to the 14-15%, but we achieved in only 3 quarters of this.
All right. Thank you.
Thank you. The next question comes from Bhagwan Chaudhary with Sunidhi Securities. Please go ahead.
Yeah, thanks for the opportunity, sir. This question related to your product, as you mentioned that dolutegravir is now on the 8th position, which earlier it was on the second or in the top 3. So if you just can say qualitatively, what would have been the contribution for your top 2 products, trazodone and dolutegravir, in these 9 months compared to the last year? It is remarkably different. The other product has taken over it. Just some qualitative comment on this.
The trazodone still remains at the top of the chart with 20% revenue generated, with three molecules contributing to this total trazodone demand. Dolutegravir product now falls to 5.83% of the total revenue in 9-month period. But to take care of this dolutegravir business, we have existing products like oxcarbazepine and the entacapone, which have contributed 8.83% and 9% respectively to replace this dolutegravir business. So these are the existing products which are giving us a good contribution at our revenue. And as I discussed, we have some new products also which are slowly becoming a larger, like nintedanib and apixaban, darolutamide.
Got you. So, sir, this decrease in revenue is mainly from the industry demand, or how the final product is playing out?
It's the industry demand only.
And do you expect it to remain muted, or there is likely?
Like Q4 started, we are now started receiving the orders for dolutegravir in Q4.
But in the longer term, do you see that it will come back on its previous level?
Yes. It will. It's a very important and potential drug for HIV, and it will come back to the normal level. Currently focusing on COVID-related issues, but definitely it will be come back to the normal, I guess.
Got it. And secondly, we have launched 2 new products already in this 9 months. Is that right?
Yes, you are talking about those import substitute products.
Okay. So this is for the innovators or the generic?
Input substitute are for the generic, only for Indian market.
Okay. And you comment as well that we are about to launch 3 more products. So those will be for the innovator category or?
No, not for input substitute only. It's for generic. Innovator products are there, which is already going on in that space, but it is an NCE program. So we are not more disclosed on that. It is going on a very, very nice space, whatever the planning is there.
Got it. Thank you.
Thank you. The next question comes from Pratik Chaudhary with Samarthya Capital. Please go ahead.
Good afternoon, sir. Sir, on the Ankleshwar facility, you had mentioned that you just about 2 months back you had got the environmental clearance for Unit 2. Is the understanding correct?
Yes.
Okay. And so what sort of capex are we planning to spend for this in, say, the next 12 to 18 months on this facility, Unit 2?
Now we are in designing and planning stage of that expansion, and as soon as we finalize the capex, we will let you know on that.
Okay. And these 2 new products which you have launched, would they be coming out from Unit 2?
No. They are all coming, both are coming from Unit 1.
Okay. And in terms of, so there are a very large number of products that you see in the EC document that has been filed. So, and maybe multiple intermediates for APIs. So, any estimate or rough number that you could give us on what is the size, opportunity size that you could potentially target with these very large number of molecules that you may launch over the next 2 or 3 years?
So these Unit 2, which is we are converting, is for pharma intermediate segments, and that is our growth for FY24 and 25. So it's a continuation of Unit 2 and it is a continuation of our revenue of pharma intermediates because in 2 years' time, Unit 1 utilization is on a full capacity. And for supporting that, we had initiated this action for Unit 2 to make in FY23 so that it will be ready for FY24 and 25. And it will be a part of the 25% growth of the pharma intermediate segments.
Okay. And what's our internal target for FY25 revenue?
Sir, annually we are growing at 25% historically, you can see, so that you can consider the same historical data on that.
Okay. Okay, sir. Thank you.
Thank you. Ladies and gentlemen, again, if you wish to ask a question, you may press star and 1 on your touchtone telephone. The next question comes from Neha Agarwal with Sage One. Please go ahead.
Thank you so much for taking my question. So I have 2 questions. One is on the line of margins. Given that yours is a pharma intermediates business, how do you ensure sustainability of margins? Because not it's kind of N-2 product in the overall pharma value chain. So how would you sustain the margins, and what is your average margin expectation over the next 3-4 years?
See, if you go through our business profile, you will realize that the USP for our business, Ami Organics business, pharma intermediate, has been to really enter into the market quite early. We, even for the generic product, we enter into the market at the launch only, and way before the product expiry or product launching through Para 4 filing or any other way. So because of that USP of entering into product very early, we have been able to drive the margins for our business. But early entry into the market is the one part, but to sustain that business is again the part of operational efficiency and product efficiency. So we have a separate team of costing wherein they look for all the product on a monthly basis for any threat arising out of any raw material price increase or any threat from competition or any other supply chain issue or any kind of issue. So they trigger various actions like supply chain improvement, yield improvement in production, or even if those things doesn't work, they trigger for backward integration and raw material development at our end. And this has resulted as a very good results in last 3 financial year, and this is the reason why we have been able to not even able to increase maintain our margin, but to increase our margins year by year.
On the same line, because you mentioned how early entry has been important, but if I talk about the nature of your business and the nature of products, can we assume that a significant portion of revenues are coming from long-term contracts? While for exports you did mention it, but on the domestic front also?
No. Domestic business is on a spot basis, because domestic we have a 2 to 3 months of order are always on hand, because the domestic is mainly for the generics, and that it's always on the spot basis.
Okay, and on a product like dolutegravir that you did mention recently, we all know that there has been an impact on the demand side, and as a result, volumes were impacted adversely. And you being one of the producers, I mean, you had little control, you could say, on the overall demand, but yet were impacted in terms of revenue. And the same could be the case for many of your products, because frankly speaking, demand is not really in your control. So how do you manage that? Because the volatility at the front end could be something which could be detrimental for your revenue consistency.
See, in revenue consistency, it is in last 10 years, we are consistently, our revenue is growing at 25%. So this is automatically prove that we are not dependent on single product. And this is also in last 9 months, the revenue from dolutegravir is only 5% compared to the revenue of FY21 of 22%, 21.5%. So you can understand that the impact of 15%, even though the growth is continuously growing. So the reason for that is the USP of AMI Organics, and that is very unique in sense that we have more than 450 products, and annually we are introducing around 5 to 10 products in our basket, and this goes for the floor for the production as well. So this is the reason why any product which is not performing well will be automatically taken care by the other products. And that is why we are conservatively always saying that our growth is at 25%.
Understood. Well, that was very helpful. On one last question on the working capital side, I just took a note that between the last 3 years, your working capital requirements have increased, and so have your receivable days. So could you throw some light there? And is it something that we can expect on a sustainable basis to be on the higher side, the receivables?
The receivable days are in the range of around 90 days. When you see our financial for FY21, you may think that it is on a higher side, but the fact is that it includes the debtors of our acquired business, 14.5 crore of debtors of acquired business, which didn't get any revenue on our P&L. So if we remove that 14.5 crore data for FY21 were 103 crore only, and that was the gross revenue for us in Q3 FY21. So debtors are in the range of around 90 days, and that continues for us in this financial year as well at the larger sale value as also. And inventories has been in the range of around 80 days on a sales basis, and similarly it is the same pace it is going in FY22 also.
Right. So I agree, 90 days is something that you can comment going forward. But if I compare it to FY19 and 20, it was still, I think, much less because from FY20 to 21, if we see your overall receivables have doubled while revenues have not grown at that same pace, right? X of the Gujarat business also.
I just mentioned about the FY21 revenue. When we see FY20 figures, when we compare, actually FY20 Q4 FY20 revenue was around 60 crore only. Because there was a shifting of our production from old unit to new unit, and because of that our production suffered, and that was the only quarter in last 10 years where quarter 4 was not the biggest revenue generator for us because of this shifting of the production, as well as in last week of the year there was a COVID situation. So revenue was only 60 crore only, and that was the kind of data we carried to the balance sheet in that year.
Understood. Thank you.
Thank you. The next question comes from Hardik Bora with Union Mutual Funds. Please go ahead.
Hi, thank you for the opportunity. Just most of the questions were answered. One question was on the fungibility of the capacity. So across let's say the specialty chemical or the pharma intermediate, how fungible is the capacity if you want to shift from one product to another?
Yes, this facility is fungible. We can utilize this facility for pharma and specialty chemical business for the domestic market. For regulated market, there are of course some regulations and change controls are required before any kind of production shifting.
But that can be also possible to do that.
Okay. And one final question is, typically when we get contracted for these new products by a customer, let's say a new customer is tied in for Tolazone or Entacapone, how long contracts do they give in terms of how many months in future contracts do we get? Typically.
On major customers, we have a 4 years contract. Whereas Entacapone, we have a similar 4 years contracts.
Okay. So hence you are able to plan your capacity well in advance as to where will the growth come from and where you can.
Yeah.
Yes. Okay. That's all I wanted to check. Thank you.
Thank you. The next question comes from Prashant Nair with Ambit Capital. Please go ahead.
Thanks for the follow-up opportunity. Just one question. So when you talk about your China substitution initiatives, outside of the 2 products that you have already launched, can you just give us a sense of how many more you're working on and any potential timeline on scale up for these?
Apart from these 2, 3 are in pilot right now, and we are targeting to be commercialized in Q1 is a time for the Q1 FY23 is a time for the sampling, and Q2, Q3 is a commercial. So in this next financial year, we are introducing 3 more. Whereas we are under R&D, there are another 4 products are right now under development. So this is how our current China substitute portfolio is working.
Yeah, great. Thanks a lot. That's it for me.
Thank you. Due to time constraint, that was the last question. I now hand the conference over to Mr. Naresh Patel for closing comments. Thank you. Please go ahead.
Thank you very much. Thank you everyone for your questions, and we hope we have been able to answer most of your queries. If we have missed out on any of your questions, kindly reach out to our IR advisor, Christian, and we will get back to you offline. Thank you very much. Have a wonderful day to you.
Thank you. On behalf of Axis Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.